We're still looking here at Chapter 14 related questions. One 223. So number 23 says last year, Mr. Corbett's adjusted gross income was $141,000, and his total tax liability was $33,650. This year, his total tax liability is $35,290. Compute the minimum amount of current year tax that Mr. Corbett had to prepay through withholding and estimated payments to avoid an underpayment penalty. So just as a refresher, I know we've looked at a lot of stuff in this chapter. Let's just pull up the PowerPoint slide here. So what this is talking about is related to you. You should be paying your taxes evenly throughout the year, whether it be through withholding or if you do not have withholding on every paycheck, make sure that you have estimated payments. And if you have withholdings, I guess it should emphasize, make sure you're having enough withheld. So what you want to do, you can either meet one or two marks here. So you can either make sure you have paid throughout the current year 90% of the current year's tax, or 100% of the prior year tax. Keeping in mind that could be 110% if your AGI for that year, for the year, is over $150,000. So the thing is, you get to pay the least of these two amounts. You might be wondering, why do they have you 90% of the current year tax? And I can't swear that this is, the absolute reason, but kind of what I have in mind is they allow you a little bit, because if you're in a usual career path, right, you usually get a little bit of an increase in your salary each year. So to me, that's kind of how I look at it. They give you a little bit of a break in the current year, or of the current year number, because you might have an increase there. And is that absolutely correct? No, but that's how I kind of think it through. And that helps me, at least when I'm studying for tests or whatever, that's what helped me understand the 90% of the current year. They're going to give me a break on maybe my current year increasing. Okay, so with all that said, let's go back over here. So we're going to look at one or two situations, right? We need to calculate a couple of situations here. So first one we're going to look at, I don't know if you say options, but one of the things that may end up being is 90% of your current year tax. So it says the current year tax liability was $35,290. So if throughout the year we had paid 90% of it, that would be one mark that we could use to make, as a reason we should not be penalized. So we look here, I did the calculation and I came up with $31,761. Okay, then the second thing here is, and let's look here to see which one of these. AGI was 141,000. So we need to see, are we going to multiply that by 100% or 110%? Well, he's just below that mark of 150,000 AGI. So we're going to take the 141,000. That would be what we would look at as far as the 100% rule. So he could either have paid 90% of the current year tax or 100% of the prior year, since he was not over the AGI limit. And I'll write this out, but that should be pretty straightforward. Last year he had 33,650. Multiply that by 100%, so 33,650. Using that option, that would be what he would need to have paid. And as I mentioned, you actually get the lower of those. So as long as he has paid $31,761, then he'll be okay. So $31,761 is what needs to be paid. Let's look at number 24 here. It says last year, Mr. Takar's AGI was $182,800 and his total tax liability was $51,650. This year, his total tax liability is $65,440. Compute the minimum amount of current year tax that Mr. Tucker had to prepay either through withholding and estimated taxes to avoid an underpayment penalty. Right, so I'll move that down a little bit because we're looking at the same scenarios. 90% of the current year tax. In this case, that was $65,440. And we multiply that by 90%. Again, try to do all this in my head for no reason. We have a calculator. 65,440 times 90%. So that's 58,896. Okay, then for the second, we're going to look at the prior year. Right, in this case, AGI was 182,800. So you can probably guess that's one reason I put that on here, is so we understand since we're over 150,000, we take last year's tax and multiply it by 110%. Right, so it says last year's tax was 51,650. So we'll write that out. 110% of prior year tax. So that would mean 51,650 multiplied by 110%. I don't think my zero went in there, but that's 51,650 multiplied by 110%. 56,815. Right, so you might think 110% being the factor, you'd always get a higher answer. But no, and this is probably one of the reasons. In this case, more than likely what's happened is they maybe have gotten a promotion, right? So not just the annual increase, you've increased your overall position. So in this case, that might be where it's helpful. So again, you get to take the least of these. And one way, remember, it's asking you up here to do the minimum amount. So that might help you remember to choose the minimum there. So 56,815 or C is going to be the answer there. So as you can see here, chapter 14 covers a lot of different things it's looking at, but that gives us at least some practice working through some of those together.